Welcome back to FX Limit. Today, we're diving into one of the most important economic indicators for Forex traders, the Consumer Confidence Index, or CCI for short. We'll be looking at what it is, how it influences Forex markets, and most importantly, how you can build some powerful trading strategies around it. And to make it even better, I'll show you how using tools like the Apex Trend Indicator can help you maximize your trading potential when it comes to CCI-based strategies. So, let's get into it. Now, for those of you who aren't familiar, the Consumer Confidence Index measures how optimistic or pessimistic consumers feel about their financial outlook and the general economy. It's a key piece of data that helps traders gauge the health of an economy, as well as the potential for future spending and growth. And since consumer spending makes up a large portion of any economy, shifts in confidence can have a pretty significant impact on currency values. In other words, when consumers feel confident, they spend more, and that can boost a country's economy and currency. On the flip side, if confidence is low, spending drops, and that can lead to a weaker currency. So how can we as traders leverage this information? Let's start with the basics. Typically, when consumer confidence is higher than expected, it's a bullish signal for a country's currency. And when it comes in lower than expected, it's bearish. For example, if the US Consumer Confidence Index comes out stronger than anticipated, we might expect the US dollar to strengthen. But how do we turn that insight into an actionable strategy? One common approach is to trade based on the release of the CCI data itself. If the Consumer Confidence Index is released and the number is significantly higher or lower than expected, that can create short-term volatility in the Forex market. Traders who can act quickly might look for an opportunity to buy or sell based on that deviation. But here's the thing. Just trading based on the number alone can be risky. Market reactions to economic data aren't always straightforward, and sometimes, the data gets priced in before the release. This is where having a good trend detection tool, like the Apex Trend Indicator, can be a game changer. The Apex Trend Indicator helps you identify whether the market is trending up or down before and after key economic releases like the CCI report. It can give you early buy or sell signals based on real-time price action, which helps you confirm if the market is reacting the way you expected. Let's say the US Consumer Confidence Index comes in much higher than expected, and you're considering buying the US dollar. Before jumping in, you could use the Apex Trend Indicator to check if the currency pair you're looking at, say USD, JPY, is already in an uptrend. If the indicator shows a strong uptrend, then that gives you more confidence in your trade. And if it shows a downtrend, you might reconsider or at least wait for the market to stabilize before entering a trade. Another solid strategy involves using the CCI to trade in alignment with overall market sentiment. Think about it this way, when consumer confidence is rising, it often reflects a broader trend of economic optimism. And when it's falling, it signals potential trouble ahead. By combining the CCI with technical analysis tools, you can position yourself for longer-term trades that align with these larger market cycles. For example, if the CCI has been trending up over several months, it might be a sign that a country's economy is on the mend and that its currency will strengthen over time. In this case, you might use a tool like the Apex Trend Indicator to find good entry points on longer timeframes, say the daily or even weekly chart. The indicator not only shows you the current trend but also provides take profit and stop loss levels, so you don't have to guess where to set your targets. Plus, it supports multiple timeframes, so you can align your strategy across both short and long-term charts. This is particularly useful when trading based on broader economic indicators like the Consumer Confidence Index, where you might want to hold positions for several days or weeks. Now, one thing to keep in mind is that not all currencies react the same way to the Consumer Confidence Index. Currencies from countries with more consumer-driven economies, like the US or the UK, tend to react more strongly to changes in consumer sentiment. But that doesn't mean you can't apply the same principles to other currencies. Just be sure to combine CCI data with other forms of analysis, like interest rate expectations or employment data, to get a fuller picture of the market. Another advanced strategy involves looking at divergence between the CCI and the currency market. Divergence happens when the consumer confidence index is trending in one direction, but the currency isn't following. For example, if consumer confidence in the Eurozone is trending upward, but the euro is still falling against other currencies, that could be a sign that the market is undervaluing the euro. In this case, you could use the apex trend indicator to find the right moment to enter a buy position, looking for the trend to reverse and the currency to catch up with the positive economic data. A final strategy to consider is combining the CCI with other economic indicators for a more well-rounded approach. While the CCI is great for gauging consumer sentiment, it's just one piece of the puzzle. You can enhance your strategy by looking at other important economic data like GDP, employment numbers, or inflation reports. When you start to see a pattern across multiple indicators, that's when you can be really confident in your trade. For instance, let's say you notice that both the Consumer Confidence Index and employment numbers are showing strong growth in the US. That's a double signal that the US dollar might be headed higher. By using the apex trend indicator, you can quickly scan multiple currency pairs to find the ones where the trend is already in your favor. This saves you from wasting time looking at charts where the trend doesn't align with your fundamental analysis. At the end of the day, the Consumer Confidence Index is a powerful tool for Forex traders, especially when combined with solid technical analysis and a reliable trend indicator like the apex trend indicator. Whether you're trading short-term news releases or taking a longer-term approach, CCI-based strategies can help you stay ahead of the market. And that's it for today's video. If you found these strategies helpful, make sure to hit the like button and subscribe to FX Limit for more Forex trading tips and strategies. And remember, if you want to take your trading to the next level, check out the Apex Trend Indicator. It's designed to help you trade with more confidence by providing real-time, accurate trend signals across multiple currency pairs and timeframes. Thanks for watching, and I'll see you in the next video.